So this is a sample question from the March-June 2023 exam, and it's a section B question for 25 marks. So let's start off by looking at the requirements. And this looks like it's going to be an investment appraisal question, 13 marks for evaluating an investment proposal, and the remaining 7 technical marks for discussion. And straight away, I'm going to copy those requirements into the word processor, and I'm going to make sure that I'm very clear in my own mind that as well as evaluating, I have to include in my analysis a specific discussion about some concerns that the Chief Executive Officer has. Okay, so let's look now at the first exhibit, and we can see here that we are a market-leading online food delivery company, and we're thinking about investing in a neighbouring country. And I know I have to evaluate for 13 marks this project, and I've highlighted a few of the key points. I'm given some inflation-adjusted cash flows for 4 years, and what isn't yet in the analysis is the effect of tax allowable depreciation and the tax rate, and a royalty payment is mentioned, and there's some investment in working capital, which I'm told will be 2% of that year's expected pre-tax contribution. Finally, I've got some exchange rates that are given and a cost of capital that is given too. So I'd work my way logically through this. It's an NPV calculation. The cash flows include inflation, the exchange rates are given, and really it's the areas that I've highlighted that you're going to have to work on. So let's look at a reasonable approach here. I'm going to take the information that's given, and I'm just going to add in the extra information for the royalty. So I'm told in the question that the royalty is 2.5 million and that it goes up by 5%. So once I've done that once, I can just copy it over. Then I've got tax allowable depreciation. I'm told tax allowable depreciation is straight line, and it's 25% of the outlay. That's the same in each year. And now I'm ready to work out my tax profit. So I've got a tax credit in years 1 and 2 because I'm making losses. And I'm told that I can just roll that forward. I'm told that in the question. So it's only when I get to year 4 that I'm going to start paying any tax, and I'm paying it at a rate of 20%, we're told in the question. So that gives me negative 17.92. Then I've got to remember that the tax allowable depreciation itself is not a cash flow, so it needs to be added back. And finally, I've got the change in working capital. And the change in working capital, well, I need to do a working for working capital, which I'm told in this question is 2% of the contribution. So it starts off at 0.88 million. Copy that across. And it's the change in working capital that's the relevant cash flow. So working capital goes up by 0.88, and then it goes up to 1.104 from 0.88, and I copy that across, and I've got my working capital movements. So those are my cash flows in the foreign currency. I'm given the exchange rate. I've got to be careful with the exchange rate. The exchange rate is quoted to the dollar, so when I convert into Turkish lira, I need to multiply by the exchange rate to get into Turkish lira. And then finally, I've got the royalty. I'm going to calculate the royalty as the amount in dollars multiplied by the exchange rate and converted into a positive number. And then I take 15% tax off that. Then I'm going to net everything off, discount at 16%, so equals NPV. 16% is given as the cost of capital. Starting from time 1, deduct the outlay, and I've got my NPV. So that's going to pick up 8 of the marks. And then I'm going to discuss, if I look back to the requirements again, evaluating the suitability of the investment proposal, Well, I've got some numbers and I can pick up good discussion marks and some professional skills marks by pointing out the positive NPV means the project gives more than a 16% return. But also, if I look back at the numbers, I'll see that all of the NPV is coming in year 4, so that looks a little bit risky. But also I can point out that everything after year 4 is ignored. So I can put in quite a lot of pretty straightforward discussion points here, and I'll refer you to the solution, but they would be under headings and they would draw from the numbers and make reference to the numbers. I also have to discuss the CEO's concerns. So what are those concerns? Well, very specifically, we're told under the numbers that we've got concerns about this model. It's untested. So yes, absolutely, we should be looking at those, at the assumptions the model is making. And a point we could make here is that we are a company in this business that has started up over the past 5 years. So we can test the assumptions against our own experience. A simple point, but a relevant one. Also, we're worried about the validity of the estimated fixed costs. So why would that be? Well, these are meant to be fixed costs, and look at how much they're going up by. They've over doubled over the course of 4 years. So that does look strange for fixed costs, especially given the rate of inflation. On the other hand, revenue's going up very quickly too. So, I mean, we don't know the detail behind the fixed cost estimates, but we have to answer the question. And yeah, the fixed costs do look like they're going up rapidly. Okay, so pretty much that is my answer to part A. We've got a reasonably simple set of numbers. We're going to lay them out properly, and we're going to analyze them. And of course, there's nothing to stop us going beyond an analysis and evaluation and into some skepticism and picking up some of the professional marks too. So why have we used a cost of capital of 16% when this looks like a higher than average risk? Do we believe the exchange rate forecasts that are given? Purchasing power parity theory isn't that accurate over a 4-year period. So we could certainly go into that sort of area too. Now let's have a quick look at Part B. Part B is a straightforward requirement asking us to discuss financial and business risks which this company will be exposed to. And there is an exhibit for us to look at that covers this. The distinction between business risk and financial risk should mean that you've got 2 separate headings in your answer. So crudely, some of the points here are that investing in a developing country is risky, that the tax treatment of delivery riders could change, and that there have been frequent changes in government that might affect tax or other regulations. So with each of those risks, you're looking to explain the point. So for example, a developing country often has erratic political and economic environments. And it may well be the case that it goes through a period over the next few years of low economic growth or high government instability. However, that seems less likely because of a change in the constitution that we're told about in the second paragraph. The treatment of delivery drivers is likely to be very important. And the fact that this has been challenged recently once and the tax authorities have lost is great, but there is clearly a risk that that's appealed or we go back and have another go and that legal regulation changes. And the same with the financial points. The restriction on dividend remittances would, if it was brought back in, mean that you weren't getting your cash back as quickly. On the other hand, not a lot of cash is going to be coming out until year 4 here. So how much of a problem is that? The high level of government debt might mean that the rate of tax went up over the next few years, and that could be a problem. Relying on financial institutions to process government payments online, while there is the risk that they don't do that well and that some of those payments don't come to you or they come late. So we're just looking for a reasonable explanation, development, and perhaps skepticism on the importance of some of these risks. And you can read through the solution and pick up the detailed points there, and that's worth doing just to see how the points are developed. None of the points are difficult, but a common problem with writing a discussion answer is that people make it too briefly. They make it as a bullet point rather than as a short paragraph. Okay, so 2 requirements, a reasonably straightforward question, important to pick up the professional marks, analysis and evaluation, to refer to down here. Analysis and evaluation just means that you're going to be determining the right calculations to use and using them to support your discussion and conclusions. Skepticism, well, you could challenge the growth estimates for fixed costs or the cost of capital or the use of purchasing power parity theory. And commercial acumen, you're just looking to make practical points. So is it reasonable to use your recent experience in the domestic market to validate the growth assumptions in this new country, which is very close to you and has the same culture? I think it probably is. And that completes this short debrief.